In this video, I will briefly explain how companies recognize accounts receivable. The term receivable refers to amounts due from individuals and companies. Receivables are claims that are expected to be collected in cash. The management of receivables is a very important activity for any company that sells goods or services on credit. Receivables are frequently classified as accounts, notes, and other. Accounts receivable are amounts customers owe that result from the sale of goods and services on account. Accounts receivable serves as a control account because it summarizes the total of all the individual customer receivables. Companies generally expect to collect accounts receivable within 30 to 60 days. Notes receivable represent claims that are evidenced by formal instruments of credit. They normally require the payment of interest and extend for time periods of 60 to 90 days or even longer. Notes and accounts receivable that result from sales transactions are often called trade receivables. Other receivables include non-trade receivables such as interest, loans to company officers, and advances to employees. These receivables do not generally result from the operations of the business. They are generally reported as separate items in the balance sheet. Recognizing accounts receivable is relatively straightforward. A service organization records a receivable when it performs a service on account. A merchandiser records accounts receivable when it sells merchandise on account. The entry to record a credit sale results in an increase or a debit to accounts receivable and an increase or credit to either service or sales revenue. The seller may offer terms that encourage early payment by providing a discount. The buyer might find some of the goods unacceptable and choose to return those items. Sales return and allowances, as well as cash discounts, reduce receivables. Let's assume that DoorDash Company sells merchandise on account to Polo Company for $1,000. The terms are 210 net 30. In this example, we will ignore the cost of goods sold entries and focus on just the credit sale. A credit sale results in a debit to accounts receivable and a credit to sales revenue, in this instance in the amount of $1,000. On July 5th, Polo returns merchandise with the sales price of $100 to Jordan Company. This will result in a debit to sales returns and allowances of $100 and a credit to accounts receivable for the same amount. On July 11th, DoorDash receives payment from Polo Company for the balance due. The journal entry will result in a debit to cash for $882. We will also debit sales discount for $18, and we will credit accounts receivable for the net amount that's due. In this instance, it would be $900. Some retailers issue their own credit cards. When you use a retailer's credit card, such as Target or Pottery Barn, the retailer charges interest on the balance due if it is not paid within a specified period of time. Typically, this is 25 to 30 days. To illustrate, let's assume that you use your JCPenney credit card to purchase clothing with a sales price of $300 on June 1st. The journal entry that JCPenney makes will be to debit or increase accounts receivable for $300 and increase or credit sales revenue for $300. And please keep in mind, we are omitting the cost of goods sold entries in this example. If you owe $300 at the end of the month and JCPenney charges 1.5% per month on the balance due, the adjusting entry that JCPenney makes is going to be a debit to accounts receivable in the amount of $4.50 and a credit to interest revenue for the same amount. Interest revenue is often very substantial for many retailers.